At Lyrical, we describe ourselves as back-to-basics investors. We're fundamental value investors. Our goal at Lyrical is to generate the highest returns we possibly can. And value is the fuel for those returns. If you take a great business, but you pay a fair price for it, you should only expect an average return. The only way we know of to generate an above-average return is to buy a business at a discount to what it's worth. And the bigger that discount, the bigger the return we generate when we're right. Our investment process begins with idea generation. We need to be able to generate our own investment ideas. So we have built a proprietary valuation screen that takes our universe, which is the 1,000 largest US stocks, and sorts them by our own valuation calculation. This allows us to focus on the 100 or 200 cheapest stocks, the best 10 or 20% of that universe, and ones that we're capable of thoroughly analyzing and understanding. Finding a company at a low multiple of, say, earnings is actually relatively easy. Getting the investment right is the hard part. Not every stock at a low multiple is actually undervalued. Some companies have low multiples because they deserve them. They're bad businesses. So for us, in order to get the investment right, there's two other things we look for beyond just valuation. One of them is quality. When we stick to companies with good returns on their invested capital, we get a lot more of them right. The other thing we look for is what we call analyzability. The simpler a business is, the easier it is to analyze and understand. Again, the greater the chances we have of getting that investment right. In the best of times and in the worst of times, it is always difficult to find these great stocks. And today is no different. The market is reasonably efficient. And it isn't in the habit of giving away good, simple businesses for really cheap prices. What we build our portfolio out of is a very rare exception. An example of a good, simple business at a cheap price that we've recently purchased at the firm is Whirlpool. Whirlpool is the leading global producer of appliances. They're in over 100 million homes worldwide and have the #1 market share in every major continent. I would argue that you don't need to be a rocket scientist to figure out washing machines and refrigerators. It is a relatively simple business to analyze and understand. It's also a very good business. They generate very attractive profits, very good returns on invested capital, comfortably above the minimum 15% that we look for. And we've been able to buy this great global leading business originally at just 11 times their earnings, which is very attractive compared to the much higher levels that the market is trading at today. We're very excited about the positioning of the portfolio today. When we look at the historical earnings of the companies we own, we see that they have grown better than the market over the last decade. They've also grown with greater consistency and were affected no worse in the recession than the overall market. And in spite of the historical earnings of our companies being better than the market in all of those ways, these companies trade at a material discount to the market today. So a significantly bigger discount with better earnings results, we think, is a great combination for producing future returns. Our investment style only works as a concentrated approach. We look for companies that have a very rare set of characteristics, both deeply undervalued, but also very good businesses and relatively simple businesses that are easy to analyze and understand. These are very rare in the market. They're few and far between. We couldn't run a 100 stock portfolio this way. There aren't 100 stocks, even in our 1,000 stock universe, that have these criteria. So the only way you can have a portfolio of what we think of as being the best stocks in the market is to do it in a relatively small, concentrated fashion.